Let's dive straight in. Welcome to Inside India. I'm Dan Murphy. Straight to your headlines this hour. First, the US dollar slides after President Trump fired Fed Governor Lisa Cook, alleging mortgage fraud in an escalating feud with the US central bank. Plus, the Trump administration signaling it will push ahead with an additional 25% tariff on India tomorrow. We have full details. And India's largest car maker, Maruti Suzuki, launches the country's first ever EV for global markets, with plans to eventually export to 100 countries. Good to have you with us. Well, we have Asia markets on the move this Tuesday session. You can see, in fact, most major indices actually falling today. The dollar sinking, gold also popping. On our headline news this morning, Trump firing Lisa Cook. So obviously more US federal government intervention at the US Federal Reserve here. The major markets have been pulling lower. Japan's Nikkei 225 among the loss leaders right now, down more than 1%. But you can see a firmly negative day for other major benchmarks. We're going to continue to track those declines for you. More insights now on that story. US President Trump has officially removed the Fed Reserve Governor Lisa Cook from the board. In a post on Truth Social, Donald Trump repeated claims that Cook committed mortgage fraud. The Fed Housing Finance Agency Director William Polt accused Cook of taking mortgages on two properties, both of which she called her primary residence. The allegations came without evidence. Cook says she'll present documents to defend herself. Her removal fits Trump's push for deeper rate cuts and to roll back diversity programs. Cook, whose term does not end until 2038, is among a string of Fed officials who have not supported rate cuts. She's also a Biden nominee and the first black woman on the board. Well, US equity futures also moving off the back of this. Part of the reason we are seeing some downside in Asia today is because when trading gets back underway stateside, the major markets are expected to also pull lower. The Nasdaq down 46, the Dow down 49, the S&P 500 also down by around 8 points at this stage. Still early days, so we'll be watching this closely as well. The Japanese yen and the euro also strengthening against the dollar as we see the USD pulling back. Some other major currencies also moving here. Dollar index at 98.32, off by 0.11%. As a result, we're seeing a slight bid for euro dollar here, 1.16, and dollar yen trading at 147.58 as well. On the trade front, President Trump says he'll slap new tariffs and export restrictions on the countries that tax or regulate US tech companies, while giving China another pass. In a Truth Social post, he warned the move is aimed at protecting American tech and semiconductors. The European Union, with its sweeping rules on big tech, could be among the hardest hit. India, too, levies a 6% digital tax, and that remains a sticking point in those trade negotiations with the United States. Trump's levies on India will double from the current 25 to 50% tomorrow. The White House has outlined plans to implement the curbs in a draft notice overnight, signaling its intention to go ahead with those higher tariffs. The notice has been unpublished since, but a version is still available on the Federal Register's website. And as those new tariffs are set to kick in, India's Prime Minister Modi is in the state of Gujarat, launching multiple projects worth over $600 million, including Maruti Suzuki's first electric vehicle for export markets. We're going to talk more about that later on in the program, but during his visit, Modi also spoke about, quote, world politics being motivated by economic interests, and vowed to protect India's farmers despite rising pressures.
Nowadays, everybody in this world practices a form of politics motivated solely by economic interest. Everybody only wants to do what suits them, and we are keeping a lookout for that. I'm speaking from the land of Gandhi, my country's businessmen, farmers, those in the animal husbandry sector, and everyone else. I promise you, for Modi, your interest is the most important.
Meantime, Fitch cautioning on those tariff risks for the Indian economy. The credit rater has kept India's sovereign rating at BBB-, not following that recent S&P upgrade. Fitch flagged India's high debt levels at nearly 81% of GDP and well above peers. It now expects growth to hold at around 6.5% next year, but also warned those new US tariffs of 50% on Indian exports could hurt sentiment and investment. Fitch says strong domestic demand and possible tax reforms could provide some relief, but high debt remains the sticking point for any ratings boost. The Indian markets, of course, coming online in about 40 minutes' time. Here's what the futures are indicating right here, right now as well. With regards to the open, a softer start expected, which would be firmly in line with what we are currently seeing playing out across Asia. So who better to give us a pulse check on the Indian markets and insight into the investment strategy on the eve of these brand new Trump tariffs? Mark Mobius is here. He's the chairman of Mobius Emerging Opportunities Fund. Mark, welcome to the program. Always great to see you, sir. So first of all, we have these brand new tariffs coming into place, 50% in the coming hours. Is India's domestic economy really going to be able to withstand the full impact of those tariffs? What's your take?
They will be okay. India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous.
Mark, stay with us just for one moment. I wanted to update our viewers on some breaking news. And one of our top stories today, we're just getting some fresh commentary crossing now from the Fed's Lisa Cook. She says there's no cause that exists for her to be fired and she will not resign. She also adds that Trump has no authority to fire her and will continue to carry out her duties. Of course, this is a major story impacting risk assets right now because what we have seen is Trump's threats to remove Lisa Cook really raising the alarm over central bank independence. Mark, while we have you, any thoughts on that?
Well, I think Trump will continue to push for lower rates. And I think there's a good reason for that. I mean, if you compare what the Europeans have been doing, the Europeans have been way ahead of the U.S. in terms of lowering rates. And I think the Fed has been much too slow. So in that sense, Trump is right. Now, the methods he's using to get his way is a big question mark. But of course, if she has, if Cook has violated the mortgage laws, then of course she should be prosecuted.
Trump is, of course, fighting fires on multiple fronts here. It's not just the outlook for the U.S. economy, but it's the ongoing trade and tariff agenda that he's leveling on the rest of the world, or at least those countries where he deems the U.S. is not getting a fair deal. And of course, India is a case in point. Mark, we were just talking about the outlook for growth there. Of course, you heard earlier as well that Fitch held off on upgrading India. Capital Economics also saying in the last 24 hours that GDP growth could slow by almost a full percentage point. You combine that with the GST changes that we're also expecting to see very, very shortly, and the outlook is looking increasingly complicated. Now, you just said that India can continue to grow through this. I want to know what that means for your investment strategy. What's your current thinking on how you're allocating around all of this risk?
Well, India is still very, very important for us. But at the same time, with these changes, we would have a lower weighting in India, but still India would probably be the biggest weighting in our portfolios because regardless of what you say, 5% growth is still incredibly high. And India's got an incredible domestic market. And more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the U.S., which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the U.S., I think the Indian economy will still be doing very, very, very well.
Mark, you've been an India bull for some time now. I'm going to dig a little deeper into this to really understand exactly what it is that you see that so many others don't at the moment. Before we do that, what sectors would you say are most resilient to this tariff risk, and where do you want to be deploying specifically right now?
Well, of course, those sectors that are dependent on the domestic consumption are the ones you want to go to. Because if you're getting an exporter, obviously exporters are going to be hurt by these tariffs, particularly in the garment industry, in the gem industry, in the pharmaceutical industry. So these are the industries you probably want to avoid, unless you can find companies that are dependent totally on the domestic market, of which there are many. And by the way, one of the interesting aspects of India, of course, is that even without an export market, the domestic market is incredibly large and growing. I mean, if you're having an economy growing at 5 or 6%, that means that your domestic consumption is going up at a very high rate. So we would focus on those companies that depend on domestic consumption, and those companies that are quite independent of government regulation, which is another big factor. As you know, India is very big on government regulations and control. So this is something we have to look at very carefully.
Indeed. Back in June, you said your fund was holding around 50% cash, waiting for opportunities. Why so much cash in the middle of this apparent India bull market? And is that still the case, or have you changed stance since then?
We've actually reduced the cash. It's about 25% now. But thank God we've been having this cash, because with the markets at these uncertain terms, particularly India, we're being more cautious, and we have to be careful in putting money in. Of course, if prices of the stocks we like come down dramatically, we'll be putting more money in the market, because at the end of the day, we like prices that are depressed.
Of course. So how has the fund actually performed, specifically the Emerging Opportunities Fund, compared to MSCI MM or MSCI EM or MSCI India? What do your numbers actually look like?
Well, actually, we've outperformed the S&P US, which is the big benchmark, by about 1 or 2%. Not a big difference. But don't forget, we've been in business for only less than a year now. So it's going to take time for us to build a track record.
You know, I think it's interesting as well. I read a piece recently, Nomura, saying 41 out of 45 EM funds cut their India holdings in July. The country is the most underweight that it's been from a fundies perspective in several years. And then also, taking a look at this latest Bank of America survey, India went from top pick in May to least preferred in August. So what are they missing? Why are they swimming against the tide? Mark, you've been a bull for such a long time. Why is your view so different to what everyone else on the street is thinking about where this market is going?
Well, I think other people on the street are looking at China in comparison to India. And as you know, China is coming back. If you look at the China index, it's moving up. So I think there are a lot of people who say, I've been out of China. Now it's time for me to switch from India into China. I think that's what's going on. But I do think that this is relatively short-term thinking. At the end of the day, India is still going to do very, very well from a longer-term perspective. And if you look at the Nifty 50, it's still at a high point and probably going higher. You know, I can see the Nifty 50 going much, much higher than where it is now. And of course, once this trade war is over, you'll probably see a lot more good news coming out of India. By the way, one of the interesting aspects of this whole thing is that as a result of the pressure that the Indian government is having, you're going to see them making more and more changes in the, let's say, the GST, the tax system, to make it simpler for businesses to operate. And there'll be a lot of reforms which will help the Indian economy grow at a better rate. Because a lot of things that are holding back the Indian economy, of course, is the bureaucracy and the complicated tax system.
So you're saying these tariffs could actually be a good thing because it would accelerate the domestic reform agenda, which would pave the way for what could be higher highs for markets. Is that the current thesis?
Exactly. That's what I think is going to happen. You're going to see the Indian government saying, oh, we've got to make some changes to make our economy more efficient, make the government more efficient, make taxes easier to understand and to pay, particularly for the medium and small-sized businesses. So I think that's going to be a big change and going to be very good for the Indian economy.
Do you think the current premium that we see on the Nifty, and in particular the Sensex, which is trading 23 times forward earnings, is justified in this environment, though? A lot of people have been coming on the show over the last week talking about how perhaps Indian markets are looking a little stretched in this environment, given the current macro backdrop and, of course, the tariff threat as well.
Yes, as you know, most of the investors look at PE. PE is the big indicator. We don't think that's a very good indicator because the P is one thing, but the E is another thing. The E can move up very fast. And in India, you'll see some of these companies' earnings, the E, moving up much faster than the P, which means that if you're looking at PE, you're looking backwards, you're not looking forwards. So we would prefer to look at return on capital and other factors that show healthy growth and healthy companies with low debt. So I think you're still finding quite a few companies like that in India.
Hey, Mark, was it a mistake for India to continue buying Russian oil? That seems to be the primary catalyst that sparked this fire in the United States that resulted in this higher tariff rate that's set to come into place tomorrow.
Yeah, I think it's possible for India to cut off purchases of Russian oil. Now it's an ego problem. I don't think the Indian government wants to be pushed around by the U.S. government, and therefore they would probably dig in their heels on this aspect. But even that, there's a good possibility that they will reduce their purchases of Russian oil. It's all a matter of price. As you know, oil prices have been coming down, and there'll be other sources where India can purchase oil. So it's quite possible that they would reduce the amount that they're getting from the Russians.
I think it's fair to say this has also lit a fire under Prime Minister Modi, a nationalist fire that seems to be carrying him quite well at the moment. Do you expect him to retaliate against these measures from Washington? And if so, how?
Well, he already has by stating clearly that he's not going to be pushed around, particularly in the agricultural area. I think this is very critical and probably a big mistake for the U.S. to be pushing on agriculture because it's such a very important part of the electorate in India. So Modi definitely does not want to harm the agricultural sector in India and therefore would not want to give in that aspect. But other areas, other industrial areas, I think he'd be willing to give in and to give a win for the U.S. in some of these other sectors.
Mark, just a few other points before I let you go. India's pensions now managing nearly $180 billion. I saw recently they've asked for permission to expand the remit here. They want to take more risk in gold and REITs. Do you think that's a smart move?
I think they've got to have gold, particularly in India, where gold is so critical. Definitely gold. And I think they should have a lot more freedom and leeway because equity is not the only game in town. They've got to go into fixed income and other areas. So I think their request makes a lot of sense.
And just finally, what's your advice to other EM investors out there looking for opportunities? If they need to rotate capital out of this market, maybe they're not as optimistic as you are, where can they go beyond India?
Probably other places in Asia like Taiwan, Korea, even Vietnam, Indonesia. All these Asian countries are still looking very good. The problem is that in order to find the kind of companies that we're finding in India and in Taiwan, high return on capital, fast-growing companies, not easy. But I would suggest people look further afield in Asia, and particularly in Southeast Asia.
Mark, wish we had more time. We'll have to leave it there. Always appreciate the conversation. Looking forward to seeing you back out here in the Middle East very soon, sir. That is Mark Mobius from the Mobius Emerging Opportunities Fund. Thank you again. Up next on the program, more tariff talk as Trump hosts the South Korean president and warns China on rare earth magnets. All of the details on the other side of this break. Stay with us. Welcome back. President Trump hosting South Korea's President Lee Jae-myung at the White House overnight. Ahead of that meeting, Trump had raised concerns about domestic politics in South Korea, specifically police raids at a military base and at a church led by a preacher that backed the ouster of Korean leader Yoon Suk-yeol. Trump also mentioned to Lee that he'd like to meet North Korean leader Kim Jong-un this year. But other than that, the meeting was largely positive, as both leaders agreed to deepen cooperation in shipbuilding and manufacturing.
We do a lot of trade with South Korea, as you know. We are thinking about contracting some ships. They build them very well in South Korea. They're also thinking about coming to our country with some shipyards to start us on the process of building ships again. You know, at World War II, we'd build a ship a day. And today we don't build ships anymore, which is ridiculous. We're going to start that again.
South Korean companies are reportedly set to invest another $150 billion into the U.S., according to Yonhap. A couple of other major corporate deals from the sidelines as well. Korean Air agreeing to buy over 100 Boeing planes, and Hyundai Motor upping its U.S. investment to $26 billion from $21 billion and establishing a robotics facility in the U.S. Despite all the deal-making, no change in the terms of their trade deal. Seoul will continue to face 15% tariffs on its U.S. exports. Trump also threatening 200% tariffs on China if Beijing doesn't give the U.S. magnets. This as the Wall Street Journal is reporting that a senior trade negotiator is heading to Washington this week to resume talks. Our Elaine Yu joins us live now with more details. Elaine, this is an interesting one.
Hey, Dan, indeed. And Trump is drawing fresh attention to U.S.-China trade tensions as these talks resume and as we inch toward the new November deadline. And his comment is part of a tactic about with the White House's approach, tying tariffs with critical technologies that critics worry will complicate a longer-term strategic planning for the U.S. And Trump also made these comments days after Beijing announced announced new rules over rare earths that will allow it to meticulously control and track any product flows in real time and to really enforce strict oversight over the rare earth supply chain. But let's take a listen to what Trump said.
If they don't give us magnets, then we have to charge them 200% tariff or something, you know. But we're not going to have a problem, I don't think, with that. But we have a much more powerful thing that's tariffs. If we want to put 100%, 200% tariffs on, we wouldn't do any business with China. And, you know, it would be okay, too, if we had to. But the magnet situation, we have tremendous power over them, and they have some power over us with magnets.
And political and Wall Street analysts tell me that they see Trump's comment as more of a throwaway line since he added 200% or something, and that they said it doesn't make sense for the U.S. to threaten tariffs on something that they need, and also that the other side could embargo. But it does highlight how the U.S. rely on these magnets that are processed through many, many complicated steps, and which China has come to dominate or have a near monopoly on. But all eyes will be on when Trump and Xi will meet. Earlier, there are speculation that Xi might go to the ASEAN summit in Malaysia in late October, but now reports say that he's unlikely to attend. And indeed, it's usually the Chinese premier who attends these ASEAN-related summits. So the conditions really have to ripen in order for Xi Jinping to make his rare appearance at that Malaysia summit. And Trump did say he will go to China, quote, probably this year or shortly thereafter. But now with rare earths and chip mixed up in the trade talks, there are many, many details and tricky parts that the two sides will have to come together and discuss and hash out before the two sides can even meet. Dan.
Really interesting to watch. Okay, we'll leave it there. Thank you so much for joining us today. Up next on the program, we are focusing in on India's consumption story as Prime Minister Modi promises lower tax rates on multiple goods by October. Arnab Mitra of Goldman Sachs joins us for the conversation on the other side. Stay with us. Welcome back to the program. Well, we are counting down to the market open in India. A few things to flag for you. We saw US equity markets pulling slightly lower overnight. Asia markets right here, right now, also firmly in negative territory off the board after we saw the US President Donald Trump firing Lisa Cook from the US Federal Reserve Board. Now, she has come out in the last 30 minutes saying there's no cause that exists for her to be fired. She will not resign, and Trump has no authority to fire her. She says she's going to continue to carry out her duties. So from a macro level, that is what is driving Asia markets today. You can see Nifty futures pulling lower off the back of that news flow as well. You can see Nifty futures sub 25,000 at the moment, down by around 22 points. So we'll watch the market as trading gets back underway. Staying in India, an automaker Maruti Suzuki set to launch its much-anticipated electric SUV called the EV today, with India's Prime Minister Narendra Modi expected to inaugurate this new model at its plant in Gujarat. CNBC TV 18's Pakashit Luthra has the details.
India's largest car maker, Maruti Suzuki, is set to commercially roll out its first-ever electric vehicle for export markets. In fact, this is Suzuki's first electric car worldwide. This is the e-Vitara that the company would be manufacturing at its plant in Gujarat. The company is set to kick off exports this month. Suzuki Motors will be commencing manufacturing of its lithium-ion battery manufacturing plant with the production of a hybrid battery electrode. The battery manufacturing plant is a joint venture between Toshiba, Denso and Suzuki. This is to indicate the company's readiness to manufacture batteries and cells for strong hybrid vehicles. The company will commence exports first to European markets in the initial phase, followed by Japan. The eventual plan is to export to 100 countries. Maruti Suzuki's plan to launch the electric SUV domestically in India has been delayed because the company had to make production adjustments. This was due to China's restrictions on exports of rare earth magnets, which the auto industry continues to grapple with, even as the situation is improving slowly. The company maintains that its first ever SUV will be launched in India within this fiscal year, which means anytime in the next 6 to 7 months. Maruti Suzuki's unveiling of the e-Vitara in New Delhi in January this year also showcased a charging plan for the country. This is an all-electric SUV with two battery options of 49 kWh and 61 kWh, providing a driving range of over 500 kilometers in a single charge. The company's plan, according to industry sources, is to manufacture around 70,000 electric SUVs in this fiscal, and a large part of this will be for exports alone. When it comes to electric vehicles, Suzuki's Indian subsidiary will face competition from Tata Motors, Mahindra & Mahindra and MG Motors, who have been selling EVs in India for the last few years. However, Maruti maintains its clean mobility roadmap is based not just on electric vehicles, but hybrid powertrains, CNG cars and fuel-efficient internal combustion engines as well.
And ahead of that launch event, Modi also urged people to buy made-in-India products during the country's upcoming festive season. He spoke about the goods and services tax overhaul and giving the consumer more spending power.
Our government is working on reforming GST by Diwali to give consumers the spending power. After the GST overhaul, taxes on many things will be lower, and it will also give a boost to small and medium-sized businesses.
India is also revamping its inflation gauge and will now source price data directly from the e-commerce giants like Amazon and Flipkart. The Statistics Ministry says this will make retail inflation index more accurate as online shopping takes up a bigger share of household spending. The new CPI series is due early next year and will also include data on airfares and streaming costs, while rebalancing weightages as food's share in household budgets shrinks. It's part of a broader statistical overhaul, including a new GDP series and a fresh services index as well. Speaking of growing online consumption, India's FMCG industry is undergoing a big shift, with online channels expected to account for 40% of all consumption by 2030. A recent report says this is being driven by the rise of quick commerce, which already makes up 35% of companies' e-commerce revenue. The trend is fueled by a rapidly growing middle class and higher disposable incomes of a young population, with India's median age at just 28. And to bet on this, global FMCG giants are renewing their focus on India's fast-growing consumption market. So let's unpack all of this with Arnab Mitra. He's an India consumer analyst at Goldman Sachs. Arnab, welcome to the program. It's great to have you on today. You're an India consumer analyst. First of all, at a headline level, just walk me through how the Indian consumer is doing right now.
Thanks, Dan. Thanks for having me on the show. If you just step back in the last 3 to 4 years, we've had a situation in India where consumption at the mass end has been actually quite weak. So we've had consistently strong growth for top-end consumers and relatively weak growth for mass consumers. And part of it was due to multiple headwinds. We had the lingering impact of COVID on household balance sheets. We had persistently high food inflation in 2022-23. And government subsidies as a percentage of GDP was dropping because the government was trying to focus on the investment cycle. Now, those headwinds are behind. What we are seeing is a sharp drop in food inflation in the last 6 months. Real rural wages are increasing at the fastest pace in many years. Government fiscal stimulus, which you just discussed, the income tax cuts followed by the GST cuts, which are going to come. And we also have something called the pay commission next year, which will give a hike to government salaries across India. So from a situation where you had multiple headwinds, we are going into tailwinds, and which is why we believe mass consumption is at a cusp of a strong revival after having seen relatively soft growth for a few years. In fact, we are already seeing signs of it on the ground. Bottom-up data is suggesting, we looked at the June quarter numbers, there was volume growth pickup across companies with pricing quite broad-based, despite some of these catalysts not playing out. So I would say that mass consumption is where our focus is, where there's going to be a big inflection in growth in our view. Top-end consumption has remained resilient, continues to remain reasonably resilient, and therefore overall consumption looks in a good place as we look ahead.
How are these new tariffs going to filter into the domestic consumption story, though? And I know the title of your most recent report, Mass Consumption is Reviving Despite Trade and Tariff Headwinds, as you just explained. But Goldman also says that these new tariffs are expected to hit 2% of GDP. So walk me through the impact overall.
Yeah, so I think if you look at the tariff impact, the impact is quite significant on certain specific industries. At a broader level, if you look at mass consumption in India, we are talking of nearly half of India still working on agriculture. Nearly 65% consumers are still in rural areas. And for those consumers, in our view, the much bigger factors are the sharp drop in food inflation, the increasing disposable income, the government stimulus that is coming through. Also, we must keep in mind the state government stimulus. A lot of state governments giving direct cash handouts to low-income consumers, especially women. And those, in our view, are the bigger factors for mass consumption. The tariff headwinds, as you mentioned, could affect middle-income consumption in certain export-facing categories, which in terms of employment share are still relatively low when we look at overall consumption. However, I think the GST cuts could be a bigger catalyst for mass consumption. If you think of GST cut, it's essentially money back in the hands of the consumer. If the consumer was buying a certain basket of goods, the government is going to keep lesser tax out of that basket by dropping GST. And that again adds to the disposable income of the consumer to consume more. So we feel the tariff headwinds are unlikely to really impact mass consumption. The other tailwinds are much stronger.
Of course, the call to arms from Prime Minister Modi has been buy India, buy India, buy India in the face of these trade and tariff tensions with the United States. I'm wondering what type of impact you expect that to have. And at another level, you also just said that the GST reforms may actually increase spending powers for Indian consumers, as the Prime Minister has suggested. Could you expand on why you think that might be the case?
Yeah. So the way India's GST works is we have 4 slabs, which is 5, 12, 18, and 28. And a lot of categories are in slabs where the GST rates are likely to be dropped based on what the Prime Minister's statements suggest. And what that would do is essentially lower the burden on the consumer. So let's say as a consumer, you were buying a basket of goods which were costing 100. With the tax cuts, it could be a 95. So you basically have lesser spending, and that money then goes into a disposable income, and you can spend more, or you can spend it on buying better products. So GST cut is essentially government giving back money in the hands of the consumer. There's no way to save a GST cut. Unlike an income tax cut, which could go into savings, GST cut typically does end up in consumption. So we would look at it more as whatever is the total amount of GST relief the government give as a basket of consumption increase for overall consumers.
Talk to me about interest rates as well. How pivotal have RBI cuts been in improving the liquidity required to drive India's consumption story? And do you expect further easing to come?
Yeah. So I think on the rate cut side, we have already seen a reasonable amount of rate cut. The transmission into the economy has probably still not happened. It takes time for transmitting rate cuts into the economy. Generally, these things help more in terms of housing as a sector, because you will have mortgage rates where there is more elasticity of demand. The rate cuts, however, could be something which takes some time to transmit. And in my view, for mass consumption, it may not be a really big catalyst. The bigger catalysts are the headline inflation number and the GST cuts and the income tax cut also, which we didn't discuss much, but there was a large income tax cut which happened in the budget, which has also gone into middle income consumers. So those, in my view, are much bigger factors than the rate cut, which probably are more relevant for a certain cohort of consumers who are buying housing.
Have we seen the full impact of those income tax cuts actually filtering through to the real economy yet?
No, we haven't in our view. So the income tax cuts have, of course, already happened. So since June onwards, consumers have been getting higher income because the tax rate has come down. But our sense is it takes time for this to translate into consumption, because there is leverage in the system. Consumers may want to first deleverage part of their existing leverage. There could also be some time lag between consumers feeling better in terms of their disposable income versus spending on the first month, where you get a slightly higher tax relief. So our sense is it probably will take 3 to 6 months. We are now at the stage where it should start filtering in. I think I would say around this festive season is the time when typically large ticket purchases happen. And that's when, some of by then 4-5 months would have passed. The consumer would have saved enough, possibly would have deleveraged enough. And that's when we think now we should start seeing the benefit flow in. GST, of course, has not even been cut. So once the GST cut happens, maybe a month or two later from there, we will start seeing the benefit of GST, which is what, Dan, we were quite encouraged that the June quarter data, despite not having these two catalysts in play, just having the lower food inflation and the more spending by the state governments, itself saw decently good pickup in the volume trajectory, and it was very broad-based, which makes us more encouraged that this could build as these other catalysts start playing out over the next 2 to 3 months.
In the short term, though, we've just spoken about how you think the GST reform might actually improve consumer spending power in India. But at the same time, is there also a view that perhaps consumers are actually holding off from spending in this environment until they wait for those GST reforms to actually filter in?
No, absolutely. That would be happening in specific categories, especially consumer durables, where there's an expectation of a GST cut, and it is quite possible that consumers would wait. It's quite logical for a consumer to wait for the GST cut to happen. So in certain categories, you're right. However, the GST Council meeting is happening on 3rd and 4th of September, so it's not too far away. For mass consumption, however, I don't think there's any hold off, because even if there are GST cuts in, let's say, in smaller categories, it's not going to lead to significant price changes enough for the consumer to wait for a purchase. So mass consumption, I don't think is going to be a challenge, even in this very short term. And even on durables, whatever, let's say, is the consumer hold off will get recovered once the GST rate is cut and the pent up demand would come in. So it's a very short term, I would say, impact, that too on more high ticket purchases.
We spoke about this earlier, but I wanted to break down what's happening in rural India versus urban demand as well, something that I know you're also following really closely. It seems as if this spending recovery is taking place in rural India as well. Rural demand indicators are looking pretty good right now. Just walk me through that trend that we're seeing at the moment and what might actually be behind the factors contributing to increased rural consumption right now.
So the rural demand has actually been the main catalyst of this initial recovery that we are talking about in the June quarter. In rural, Dan, a few things have happened. Firstly, the agri cycle has been really good. We had a very strong winter crop and we've had a really good monsoon till now in this summer season. And therefore the agri cycle, production cycle is doing very well. The food inflation being low and also nominal wage increases in agri means that the real wage growth in rural India is actually running at a multi-year high right now. In fact, the real agri rural wage is running at around 4.5%, with nominal running at 7%, which is significantly higher than the near zero to low single-digit real wage growth in the last few years. So I think in rural, the main catalyst is the agri cycle and the inflation being low, coupled with the fact that a lot of these direct cash transfers happening in the state governments are happening to low-income consumers. And a lot of them, obviously, the larger proportion of those consumers reside in rural India. So the rural recovery is, I think, already showing up. In urban, what is happening is the top end of urban, as I mentioned, has remained very resilient. And that remains very resilient even now, because that's more driven by wealth effect. But the middle urban or the low-income urban consumers were under severe stress, I think, from the food inflation. And that's where I think the reduction in food inflation, we are starting to see some pickup. Most companies we cover in the earnings calls highlighted the fact that they are starting to see green shoots in urban mass consumption, which has been probably the weakest part of the whole setup and consumption. And that's where I think the things like the GST rate cut, the income tax cut, those things which will now play out will also help revive urban consumption. So yeah, so rural, I think the catalysts are already there. Urban, the catalysts are in place but have not yet fully played out, which is where we expect that also to start recovering.
Urban still looking mixed. Arnab, how closely are you watching indicators like retail credit growth, for example, to get a gauge on exactly how much spending is taking place right now? And do you think retail credit growth may have turned a corner now?
So on the retail credit growth, the data still suggests that it's not yet picked up. However, there was a significant slowdown in retail credit growth last year. So the contraction effect or the impact of that slowing down is probably behind, but we are yet to see a pickup. So it's an important data point to note. But as of now, we have not seen signs of that picking up. However, I would also highlight that if you look at, again, if we talk really of mass consumption and low-income consumers, retail credit growth is probably more relevant for middle-income consumption, which is where around the festive season where you have larger ticket purchases of automobiles or durables, that's when we will start seeing some pickup there if the stimulus has started having some impact. For mass consumption, it's not actually a very important data point we track, and which is why we think that side of mass consumption is already reviving, even without the retail credit growth really picking up.
So that's what's happening inside the country. Let's talk about the investability of all of this as well for our global audience. I know you don't talk stocks specifically, but Goldman has said that it prefers stocks with bottom-up drivers. So what sectors do you expect to drive that performance if this momentum that we're seeing on the overall spend stays intact?
Yeah. So I think the way we look at the investment here is that it's a rising tide right now. Consumption is going to recover at the mass end, probably in the urban end also, as some of the other catalysts play out. So it's a rising tide where all companies get a higher growth than what they have in the past. However, we in our past research have also written multiple times that we really feel white space addition is a major part of FMCG growth algorithm now. So there are a bunch of companies who are adding significant new categories, which are categories of the future. And these categories are growing very fast, and companies which have already invested in those in the last 3-4 years, and therefore they have this ability to grow significantly above the overall market growth because of those white spaces ramping up now. That's where we feel the bottom up catalysts are also as important. So I think generally there is a case for all companies to grow a little faster, a case to go overweight on consumer stocks. However, companies which have those bottom-up catalysts or market share gain or white space addition would outperform, like they have done even in the slowdown of the last few years.
Arnab, before we let you go, of course, there are a lot of headwinds, a lot of concerns about exactly how the consumption story is going to unfold. We mentioned trade and tariffs. We mentioned what's happening domestically, politically as well. Of course, with the GST reforms, we still don't know if the government is going to be able to get the states on side as well. What would you say is the biggest single headwind to the consumption story in India right now?
Yeah, I think the biggest risk to this thesis playing out, in our view, will be if it is actually very category specific. I mean, so essentially we are seeing significantly higher levels of competition in the Indian consumer space than in the past. It's driven by the fact that e-commerce has picked up as a channel. A lot of digital-first brands have come. A lot of local, regional brands are starting to emerge in India. And there are certain categories where I think the competition is disruptive in nature, where there has been significant large investments into those categories by new players. And therefore, the risk in my mind, Dan, is that the recovery plays out, revenue growth for the sector goes up, but there could be categories where the market share of the market-leading incumbents is taken away by other players, or there is a margin impact, which from an investability point of view also matters as much as the overall growth. So I still feel very comfortable about the macro top-down, but bottom-up, we have to be very cognizant about these competitive headwinds or competitive battles in certain categories that are there.
Okay, Arnab, we'll leave it there. Appreciate the conversation. Thanks for coming on today. Arnab Mitra there from Goldman Sachs. And India markets have just joined the trading day. We'll take a look at some movers in the market on the other side of this short break. Stay with us. Welcome back to the program. India markets coming online right here, right now, taking a look at how the Nifty 50 is performing. And as you can see here, following Asia markets into negative territory, down by 0.7% at the open. A lot to keep in focus here, particularly when it comes to the macro drivers. Of course, tariffs of 50% set to come into place in the coming hours, impacting across the Indian economy as we see this trade and tariff dispute with the United States showing no signs of easing up. And of course, at a headline level, what we also see in the United States is more concerns about Fed independence, which is ultimately impacting the state of play across Asia today. Moving on, and the State Bank of India is formally requesting for approval from the banking regulator to allow banks to finance acquisitions, according to the SBI's chairperson. It could start with listed companies where information is more transparent. Currently, Indian banks are barred from such lending, with companies leaning on non-banking financial firms to fund deals. Right now, you can see the shares down by around 0.5%. And over in the US, as the government gets a 10% stake in Intel, White House economic advisor Kevin Hassett says the government should not intrude on Intel's business, but it could follow the same model to get more equity in other companies.
The bottom line is that because of the CHIPS Act, the U.S. government had decided to give a whole bunch of money to Intel. And President Trump and Howard Lutnick, Secretary Lutnick, talked to Intel about the progress they were making in the hurdles that they had to hop over in order to get the money, and I don't think they're particularly happy with that progress. And so in the end, they worked out a deal where Intel is going to get the CHIPS money, but in exchange, we're going to get some equity. And the equity is not voting, so there's not going to be government intrusion into the business of Intel. It's more like a down payment on a sovereign wealth fund, which many, many countries have.
Kevin, though, is this the beginning of a larger effort by the U.S. government to take equity stakes in other industries that we subsidize or other companies in the AI and chip space that we subsidize? So a good example is AMD. Another example might be Taiwan Semiconductor.
Right. Well, I think this is a very, very special circumstance because of the massive amount of CHIPS Act spending that was coming Intel's way. But the president has made it clear all the way back to the campaign that he thinks that in the end, it would be great if the U.S. could start to build up a sovereign wealth fund. And so I'm sure that at some point there'll be more transactions, if not in this industry, in other industries.
Okay, so we should expect the U.S. government to be taking more equity stakes in businesses around the country. That is something that if you're a CEO this morning watching us, you should say, okay, the sovereign wealth fund may be coming and trying to effectively buy in some kind of equity stake.
It's possible. Yeah, that's absolutely right. You know, that if in the past the federal government has been giving money away lickety split to companies, and the taxpayers have received nothing in return. And so now what's happening with the Intel deal is the CHIPS Act money is going out as planned, but instead of it just going out and disappearing into the ether, the U.S. taxpayers are getting a little bit of equity. I can really not see how anyone would think that's a bad thing, unless you thought that the government was then going to go in and run the company. But these are going to be shares that don't have voting rights. The government's going to stay out of it.
And that's all we have time for today on Inside India. Thanks for joining in. Stay with us here on CNBC. Access Middle East is up next.